All right, in today's video, we'll check up again on how what I think has the potential to be a crash in the stock market is progressing. And in my last video, I noted that we had this 4-day rule that after a long intermediate move, 4 days in the opposite direction will often mark a turning point. In this case, it would be a top. If we were moving in the other direction, then it would be a bottom. It works either going up or down. And so far, this is still has all the signs of an intermediate top to me. So I don't think you want to buy the dip yet in this market. Now, I will say this. The Jackson Hole Symposium, the big Fed meeting, is in about a week and a half, and the Fed is going to fight tooth and nail to hold off this correction, if at all possible, ahead of that event. I think it's August 24th, I think is the first day, 24th to the 26th, if I'm not mistaken. So they're going to fight tooth and nail to try and prevent this from getting out of control ahead of that event. So we've got a support zone right here. Let me mark that. All right, so this is like between 44.60 and 44.50-ish, somewhere right in there. This is a technical support zone. If this gets broken, it's going to take the technical traders out of the market. They're not going to be buying once the support zone breaks. So the Fed is going to fight tooth and nail to try and keep the S&P above this level. And what they're really concerned about is the banking stocks, way more so than just the indexes. But if the indexes break and start a severe intermediate decline, the banks are going to follow. So let me show you the banking index here real quick. All right, so this is what the Fed is really worried about, more so than the indexes, is the banking stocks. The regular stock market has made some really nice gains, especially tech. But the banking sector is not out of the woods here. They have not even been able to rally up and get back above the declining 200-day moving average. So if the stock market starts a severe move down into an intermediate cycle low, there is a serious risk that the banking stocks can come down and break below this May pivot. And that would be bad news. We would have some more of those regional banks that are going to go under in that event. So the Fed is clearly pumping liquidity into these banking stocks. They do not want this to roll over in a hard move down and make a lower low. So there is going to be a huge effort made to try and prevent the S&P from breaking this support zone here. Now, I will say there's a small possibility that maybe the Fed could stop this right here and just turn this into a minor daily cycle low. Then we get a rally probably into that meeting on the 24th through the 26th, and then we roll over and we have to have like another complete daily cycle that gives us that final intermediate cycle low. However, I think that is unlikely at this point. Let me show you why. All right, so this is the NASDAQ composite. Here was our last intermediate cycle low, and as of last week, we're on week 21. Generally, an intermediate cycle most of the time runs from trough to trough about between 20 and 25 weeks, and this was week 21. So we're running out of time, and most likely what is occurring is that the daily cycle is now in the declining phase, and we're late in that daily cycle. So this is why I think there's one of the reasons why I think there's a strong possibility that we're going to get some kind of a mini crash event into that bottom. We've kind of run out of time, so I don't think it's likely that the Fed can stop this, and then we have to have another complete daily cycle. For that to happen, you're looking at this cycle running 27, 28 weeks before it puts in an intermediate bottom, and we're in that timing band for it right now, and it is starting. When you get really late in an intermediate cycle like we are now, and price drops below the 10-week moving average, it almost always means that an intermediate decline has begun. And you can see that the NASDAQ has dropped below that 10-week moving average. So unlikely, in my opinion, that they're going to be able to stop this and then create another complete daily cycle that gives us that ICL bottom maybe in late September or early October. That just seems unlikely to me. I think a lot more likely is that next week and maybe half of the week after, we're going to have a really big hard move down in some kind of probably a mini crash event. And no matter how much the Fed tries to prop it up, I think they're unlikely to be able to succeed here. Now, they're going to try hard because they got that Jackson Hole Symposium here in a week and a half, but the more they try and fight the correction, likely the worse they're going to make this. So this is one sign that's clearly saying that we've started an intermediate decline. We're late in this daily cycle. We've run out of days and weeks for this to produce the declining phase, so it's probably going to have to unfold very quickly in the next week and a half. Now, this is the next one is the one where the real serious problem is at. All right, this is the economically sensitive semiconductor sector, and this is a semiconductor index, and you can see, especially this past week, price just sliced right through that 10-week moving average. 10-week moving average is starting to flatten and turn down. That's one of the parameters that almost always gets met during an intermediate decline, is the price will drop below and turn the 10-week moving average back down. So that's going to have to happen on the S&P, and you can see that the semis are already in significant trouble. They've done significant damage to this chart. I don't think they're going to be able to turn the general stock market indexes back up if the semis aren't participating. They're probably the second most important sector after the banking sector is the semis, and they have turned down and are they have serious damage to this chart that is probably not going to be able to be recovered until we get our intermediate degree bottom. So I don't think you want to buy this dip. You could buy previous dips. This one is not the one to buy. You want to let this finish the intermediate decline. And let me go back to the S&P real quick. All right, this is the weekly chart. So a couple of parameters that need to be met before we try and start looking for a bottom on the S&P. Price has to break this 10-week moving average, has to stay below it long enough to turn this average back down. Now let me go to the daily chart. All right, this is the intermediate trend line. ICLs, intermediate cycle declines, almost never end until this trend line is broken. And usually price will drop considerably below the trend line. This takes out the technical traders, washes out all of the longs, cleans out sentiment, and then you can get a bottom and then resume the bull market. And the bull market's not over in stocks yet. Also notice that price just got stretched way too far above this 200-day moving average. We've got to shrink a lot more of this gap between price and this 200-day moving average, in my opinion. Maybe we even have to come all the way back down to the 200-day moving average before we can put in a bottom and then start the next rally. And because we are running out of time in this daily cycle, I think that's and because the Fed is fighting this and trying to prevent the correction from happening, I think this is setting up the conditions for some kind of a mini crash where we could, get a very aggressive and quick move back towards this moving average. So this is another parameter that needs to be met. We're just not going to bottom until price closes below this trend line, probably considerably below this trend line. And then the next and last parameter that we need to see, cycle declines, and it doesn't really matter whether it's a minor daily cycle or a larger intermediate decline. Generally, I don't try and call a bottom until they retrace at least back to the 38% Fibonacci level. And in this case, because price has gotten stretched so far above the moving average, the decline should be especially damaging. So I kind of doubt that this is going to stop at the 38. I think we're probably going to go at least 2 or pretty close to a 50% retracement before this is done. So people get the wrong idea. They think because this move was so powerful that the correction, that means the correction is going to be mild, and that's not generally the way markets work. And what happens is you get a lot of people that chase during this runaway move. So you got lots and lots of stops all along this almost parabolic structure here. And so when the profit-taking event starts and you start tripping those stops, you just have a lot of them to pile through before you finally run out of sellers and get the bottom. So these runaway moves make people believe that any correction is going to be mild, and it's almost always the exact opposite. The more powerful these runaway moves are, the more serious the corrective move tends to be when the profit-taking event gets started. And I'm about 95% convinced that it has started. Well, it has started. The only question is whether or not the Fed can stop it here, get a little bounce for a week and a half, and then it resumes. I doubt that's going to happen. I think more likely we're going to have some kind of a mini crash event that's going to take price at least to the 38, probably to the 50 before we're done with this correction, and then we can start the next intermediate degree rally. So too early to buy stocks just yet. I wouldn't even begin to think about buying until we get back down to the 4,300 level, and we're going to need to get it back down to the 4,200 level before we want to buy. And very often you'll get some kind of a small bounce. These often play out as an ABC move, and I've seen this happen many, many times. People will buy during that first bounce, and I'll get emails telling me that the correction's over, and I'm missing the rally, and then of course it rolls over. We get the C wave decline, and then that's actually where you want to buy.